Well, let's take a look at the construction and uses of security market indexes. A security market index, well, what have we got here? It says represents the value and performance of an asset class, security market, or a segment of the market over time. And so we'll calculate an index value from the market prices of the securities that are included in the index. And there are various weighting schemes for the securities in an index, and we're going to focus on that here, whether it's equal weighted or price weighted or value weighted. First, let's talk about total return versus the price return. When we talk about the price return on a group of securities, it's just the ending price over the beginning price minus 1, right? That's just our holding period return based on prices. But when you hear the term total return, that's the return, the price return, and the cash flows from the security, dividends on stocks. So the dividend yield plus the price return would be the total return. And we can calculate this as the ending value plus the cash flows during the holding period divided by the beginning value minus 1. So that's the total return, total holding period return in this case. So when we decide we need to construct an index, what sort of decisions do we need to make? Well, what market does the index represent? Which securities will be included? Those are called the constituent securities here. Which weighting method will we use? And when and if the index needs to be rebalanced? And over time, when will the index's securities be re-examined? For indexes over time, sometimes securities are taken out of that index for various reasons and replaced with other constituent securities. So our first weighting scheme we want to look at is a price-weighted index. The Dow Jones Industrial Average is a price-weighted index, and simply it started out back when, Dow Jones did it and said, let's give an indication of how the overall market did today. And they took stocks, I forget how many it was, maybe 8 at that point in time, and they added up all their prices and divided by the number of securities, divided by 8. So that was an indication of how the overall market did. That was, I think, the first index, at least the first significant index. And how would we match that up? How would we set up a portfolio that matched a price-weighted index? Well, if we bought an equal number of shares of each stock in the index, we'd match a price-weighted index. So if we bought 100 shares of a $5 stock, we'd invest $500 there, and if there were another stock that's trading at $30, we'd invest $3,000 there to buy an equal number of shares, 100 shares of that. So the thing we need to remember about a price-weighted index is stocks with higher prices have a greater influence on the index. A 10% change in that $30 stock, a $3 change, is going to affect the index more than a 10% change in that $5 stock, which would only be 50 cents. So another example is the Nikkei Dow Jones Average, the large stocks on the Tokyo Stock Exchange. An alternative to a price-weighted index is a market cap-weighted index. The S&P 500 is a market cap-weighted index, or sometimes we call this a value-weighted index. Now, in this case, we're not going to consider just the prices of the securities, but the overall market capitalization. And the overall market capitalization is the price of a share times the total number of shares that are outstanding. So that's the total market capitalization for that firm. And we sum those over the firms, and we're going to have in the numerator the total value of all those stocks at today's prices over the total value of all those shares at some base year prices. And then we multiply that times the beginning index value, and many times indexes begin with a value of 100. And so then we can calculate percentage movements relative to that. So in order to construct a portfolio, say you're investing in the Vanguard S&P 500 index fund, okay? Well, that portfolio is going to invest in each stock in its proportion of the total value of all the stocks, the total market capitalization of all the stocks in the index. Now, in this case, it's not the prices, but the market capitalization that influences the index. So the largest firms in the index, Apple in the Standard & Poor's 500, has the largest market capitalization, at least at the time I'm recording this, of about $1 trillion. And so a 10% change in that, in the price of Apple, is going to affect this index way more than a 10% change in the price of the smallest market capitalization stock in the index. So just in general, a market cap weighted index puts more weight on the performance of the stocks with the largest market capitalizations. And we say sometimes that a market cap or value weighted index has a momentum tilt. And the reason is, as a stock goes up in value, its impact on the index gets larger as its market capitalization gets larger. So if there are some overpriced and some underpriced shares in there, the overpriced ones are going to have higher weights in a value-weighted index. So that's why we say a momentum tilt. That is, stocks that have run up in value have more influence on the index. And so we have, we've tilted our strategy, putting more weight on those companies that have had positive price increases over the recent past, and less weight on those that have decreased in value over the recent past. Sometimes we'll make adjustments to this market capitalization. A float-weighted index, okay, looks at not the total shares that are outstanding, but the investable shares. They exclude the shares of controlling investors, and often those held by governments or corporations, because these are not really available for trading. So Bill Gates still owns a lot of shares of Microsoft, and he's not trading those shares. Right? So they're wouldn't be considered part of the investable shares. So the market float-weighted index is looking at that smaller number than the total number that are outstanding. And related to that is the idea of a free float index. There may be on some exchanges shares that are not available to foreign investors. So a free float index, same calculations we looked at before, but now it's not the total number of shares, it's not the investable shares, but also these shares that aren't available to foreign investors are not counted. So that would be a free float index. Another weighting scheme we might consider is a fundamental index weights. Proportion of index weights are based on the proportion of the total value of some fundamental factor. Now, think about it this way. The S&P 500, we weighted each stock in that index by its proportion of the total of the market value of all the stocks in the index. But now let's consider a fundamental index weight based on sales, revenue. Okay. So now the denominator is going to be the total revenues of all the stocks in the index, all the companies in the index. And the numerator for their weight is going to be their revenue. So the weight on each stock is the percentage of the total revenue of all the stocks in the index. Okay? It's proportion of that. So same thing we did with value, but we're doing it with revenue now, or earnings, or book value, some fundamental factor. And rather than a momentum tilt, we say this leads to a value tilt. So high book to market, stocks with high accounting book values relative to their market values are going to have higher weights compared to a value-weighted index if we weighted by their book value rather than by the total market values. And for international indexes, sometimes we weight the countries in the index by their proportion of the total gross domestic product of all the countries included in the index. So these would be GDP weights. The weight on the securities of country X are going to be country X's percentage of the total GDPs of all the countries in the index. And our third one here overall is an equal weighted index. So in an equal weighted index, we're going to put the same dollar amount in each of the securities. And the index return is just going to be the average holding period return on all the stocks in the index. Now, this is going to require rebalancing. If I have it, just think of a 10-stock index, and I invest $100,000, I put $10,000 in each stock in the index. Well, once we've had one day of trading, it's not going to be equal weighted anymore because all the prices have changed. And so this is going to require rebalancing, but we don't rebalance daily. Okay? The weights are allowed to drift, and then we rebalance at some point. That is, we sell the ones that have appreciated and buy some of the ones that have done relatively poorly compared to the other ones, and bring them back to these equal dollar weights. And this rebalancing is often done quarterly. Now, if you think about a price-weighted index, okay, we don't need to do this rebalancing. When the price goes up, more of our money is invested in that stock because it has a higher price, and we don't have to rebalance. And the same is true of a value-weighted index. Okay? If market capitalization of a company, if their shares double in price, then their market capitalization is doubled, and the value proportionally has doubled. So we don't have to rebalance those. This rebalancing is really most important with an equal weighted index. So let's compare these weighting schemes, and we're going to compare them relative to a market cap weighted index, because I guess that's the favorite these days. So a price weighted index is going to put more weight on the high price stocks. Now what happens when we have a stock split? Well, with a price weighted stock, we really have to deal with stock splits. Okay? So if a stock split, stock's trading at $80 and they split 2 for 1, that price is going to fall to $40. Well, that means that the weight on that stock is going to go down. Remember, we said we could match a price-weighted index by buying an equal number of shares. So if we bought 100 shares, well, of each stock, and then one of the stocks splits, well, now we've got 200 shares of that. So we're going to end up rebalancing, because in that portfolio, we would now have 200 shares. We'd sell off 100 of those shares to get back to our portfolio weights that would match a price-weighted index. With a market cap-weighted index, okay, if there were a 2 for 1 split, it doesn't change. The price falls in half, but now the shares outstanding have doubled, so the total value of all those shares, that market capitalization, hasn't really changed. An equal weighted index is going to place more weight on the small capitalization stocks and less on the large capitalization stocks compared to a market cap weighted index. And remember, we need to rebalance with that equal weighted index on some sort of schedule. A float-adjusted index more closely matches the proportions of investable shares. And we said a fundamental weighted index has a value tilt relative to a market cap weighted index, which we said had a momentum tilt. So let's do some calculations here, just to make sure we understand the mechanics of this. We've got first a price-weighted index. So here's our beginning prices right here. Okay. And a month later, here's our new prices. Well, simply with 3 stocks here, we start out, and initially the index value is the total of all those prices divided by 3. So we get 30. And then at the end of January, a month later, we add up all the prices, get 75, divide by 3 again, and see that the index has fallen to 25. Well, we can calculate our price change in the index as ending index value over beginning index value minus 1. So we've had a decrease in the index value of 16.67%. Had we bought equal number of shares of each of these stocks, that portfolio would have had a return over this month of pretty bad, minus 16.67%. Now sometimes we have to adjust the denominator of this. Say that we've got January 31st. So say that the next trading day is February 1 here. And that stock A split 2 for 1, effective at the opening on February 1st. So if this stock splits 2 for 1, its price is going to be 10 with a 2 for 1 split on February 1st. Well, we don't want the index to drop down because they split 2 for 1. That would be giving the wrong information. Okay? There really wasn't a big decrease in the value. It's just that there's more shares now and each has a lower price of $10. So what we would do is we would adjust the divisor here. So let's say all these stayed the same. So at the opening, we're going to treat them as all the same, except now we've got 10 here, we've got 15 here, 40 here. So we could add all those up, and we should get 65 here. Okay. And now, if we open and say, well, the index is 65 over 3, that's not correct. So what we want to do is take the closing index value and say, well, it equals 65 over some number x. So we're going to adjust this divisor so that if the only change in price had been the change from $20 to $10 because of the split, the index would open at the same level. So we just solve for that divisor that makes the index value with the new price equal to what the index was with the old price. Now let's take a look at stock splits again. We've got 3 stocks here in our price-weighted index. Okay. Index value equals 40. If C splits 2 for 1, what's the new denominator for the index? So can you think about that for a minute and how you might solve for that based on that example I just gave you? Well, we've got to adjust. If stock C is at 90, splits 2 for 1, then with no other changes, that would be priced at 45. So now our total value of stocks in the numerator there is 75, and we want to find that divisor that would keep our index value at 40. So if we solve for that, we can come up and see that our new index value has changed quite a bit, from 3 to 1.875. And remember, if we've got a portfolio tracking this price-weighted index, we're also going to have to adjust our holding of shares, because now stock C, after the 2-for-1 split, is going to have less weight in the index than it did previously. And that means also, if it has less weight in the index, stock A and stock B end up having greater weights in the index after the split. Now let's look at the calculations for a market capitalization or value weighted index. We've got share prices, and those are the total number of shares outstanding. And we've got 3 different share prices there, 100, 10, and 1. And we get the market cap by multiplying share price times the number of shares outstanding. And if we add all those up, that's our beginning period market capitalization, the total value of all the shares of all the companies in the index. And we set that beginning value of the index to 100. So now let's try and calculate the capitalization weighted index if stock A's price doubles or if stock C's price doubles. So stock A doubles to $200 a share. The index value goes to 50 million over 40 million, and then we multiply that ratio times our base period index value of 100 and get 125. Well, we can see that the value of this index portfolio, this value weighted index, has gone up 25%. Now stock C has more influence on the index because of its larger market capitalization. Its market capitalization started out, and let's just go back here for a second. You see our effect there was a 25% increase when stock A doubled, but stock A's market capitalization was started out at only 10 million. So if stock C doubles from $1 to $2, the index goes up by 50%. Reason being, the total market capitalization of our initial portfolio of C was twice that of stock A, that had an initial market capitalization of 10 million compared to 20 million initial capitalization for stock C. So we're just illustrating that the stocks with the greatest market capitalizations have the most influence on the index in a market capitalization weighted index. Now let's look at our equal weighted index. We're going to have an initial index value here of 131. We just take the arithmetic mean of the holding period returns on these stocks, and that would be the return on a portfolio if you started out with equal amounts invested in each stock. So there's that arithmetic mean. So our current index value would be 131 times 1 plus the 11.9% increase. So we increased the index value of 131 by 11.9%, and we'd see an index value of 146.59. So remember, we're just taking the average return on each stock of the average of the returns on each stock in the index.